Hello and welcome back to our ACCA Financial Reporting series. Today we are diving into Chapter 6, which covers two vital international accounting standards, IAS 23, Borrowing Costs, and IAS 40, Investment Property. Both of these standards are frequently tested in ACCA FR exam questions, whether in Section A multiple choice items or within complex Section C balance sheet adjustments. By the end of this presentation, you will have a clear, step-by-step understanding of how to capitalize borrowing costs, how to classify property correctly, and how to account for fair value changes and reclassifications. Grab your notebook and financial calculator, and let's get started. We will begin with Part 1, focusing on IAS 23, Borrowing Costs. In business, when a company builds a massive asset like a new factory or power station, it often takes out loans to finance the construction. The core question IAS 23 answers is simple. Should the interest on those loans be treated as an immediate expense in the income statement, or should it be added to the cost of the asset on the balance sheet? Let's look at the rules. Under IAS 23, the core rule is mandatory capitalization. If borrowing costs are directly attributable to the acquisition, construction, or production of a qualifying asset, you must capitalize them. That means adding the interest expense directly to the carrying amount of the asset on the statement of financial position. Any other general borrowing costs that do not relate to a qualifying asset must be expensed immediately in profit or loss. Now, what exactly is a qualifying asset? IAS 23 defines a qualifying asset as an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Think of large-scale projects, constructing a manufacturing plant, building a power plant, developing custom real estate, or producing major infrastructure. Notice what is not a qualifying asset. Standard inventory produced in large quantities on a repetitive basis over a short time frame, or assets that are already complete and ready for use when purchased. Timing is everything in IAS 23. You cannot just capitalize interest whenever you feel like it. There is a strict timeline window. First, commencement. Capitalization can only begin when all three of the following conditions are simultaneously met. 1. Expenditure for the asset is being incurred, meaning cash has been spent or liabilities created for the project. 2. Borrowing costs are being incurred, meaning interest charges have actually started accruing on the loan. 3. Active development activities are underway, meaning physical construction or necessary administrative/technical work has started. Next, suspension. You must pause or suspend capitalization during extended periods when active development is interrupted. For example, if construction stops for 3 months due to a strike or regulatory hold, interest during those 3 months goes to P&L as an expense, not to the asset. Finally, cessation. You must stop capitalizing borrowing costs when substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are complete. Now let me explain how we actually calculate the amount to capitalize. There are two scenarios you will encounter in exams. Scenario 1. Specific borrowings. This happens when a company takes out a dedicated loan specifically to build a particular asset. The formula for specific borrowings is capitalized borrowing cost equals actual interest incurred minus any temporary investment income earned. Why do we deduct investment income? Because if the company draws down the loan funds in January but spends them gradually over the year, any unspent cash deposited in a bank earns interest. IAS 23 requires you to net this interest income off against the total interest expense. Scenario 2. General borrowings. Sometimes a company doesn't take out a new loan, but uses funds from its general pool of existing debt like overdrafts or existing corporate bonds. In this case, you apply a weighted average cost of capital (WACC) rate to the actual expenditure incurred on the asset during the period. Remember, the capitalized interest cannot exceed the total actual interest expense incurred by the company during that period. Now, let's transition to Part 2 of Chapter 6, which covers IAS 40, Investment Property. Property accounting can get confusing because land and buildings can be used in many different ways. IAS 40 gives us precise guidance on how to identify and account for properties held specifically for financial return rather than operational use. What qualifies as an investment property under IAS 40? An investment property is land or a building or part of a building held by the owner or lessee to earn rental income, capital appreciation, or both. Examples include land held for long-term capital growth, a vacant building intended to be leased out under an operating lease, or a building being constructed for future use as an investment property. Now, let's look at what is excluded from IAS 40. 1. Owner-occupied property. If the company uses the building for its own offices, factory, or warehouse, it is accounted for under IAS 16 property, plant, and equipment. 2. Properties held for sale. Properties constructed or acquired for immediate resale in the ordinary course of business belong under IAS 2 inventories. 3. Intragroup leases. Pay close attention to this for group accounts. If a parent company rents a building to its subsidiary, in the parent's individual accounts, it is an IAS 40 investment property. But in the consolidated group financial statements, because the group as a whole occupies the building, it must be reclassified as an IAS 16 owner-occupied property. Once an investment property is recognized initially at cost, IAS 40 allows a company to choose one of two accounting policies for subsequent measurement. Option 1. The fair value model. Under this model, the property is revalued to its current fair value at the end of every financial year. Here is the most critical exam rule. All gains or losses arising from fair value changes are recognized directly in profit or loss P&L. And under the fair value model, no depreciation is charged. Option 2. The cost model. Under the cost model, the property is carried at cost less accumulated depreciation and any impairment losses, following the standard treatment under IAS 16. Note that whichever policy a company chooses, it must apply that policy consistently to all of its investment properties. To make sure you never confuse these standards in an exam, let's review this comparison table. IAS 16 PPE, used for owner-occupied properties, measured using either the cost or revaluation model. Under IAS 16, revaluation gains go to other comprehensive income, OCI, and accumulate in a revaluation surplus reserve. Depreciation is always charged. IAS 40, investment property, used for rental properties or capital appreciation, measured using fair value or cost model. Under the IAS 40 fair value model, fair value gains go directly to profit or loss P&L, and no depreciation is charged. IAS 2 inventories, used for property held for short-term resale in the ordinary course of business, measured at the lower of cost and net realizable value, NRV. Spotting which standard applies is often worth 2 to 4 quick marks in Section A. What happens when a property changes its purpose? IAS 40 provides clear rules for transfers. Case 1. IAS 16 owner-occupied to IAS 40 investment property. When the owner vacates a building to lease it out, you revalue the property under IAS 16 up to the transfer date. Any revaluation gain goes to OCI and revaluation reserve. Once it crosses over into IAS 40 at fair value, future gains go to P&L. Case 2. IAS 40 investment property to IAS 16 owner-occupied. When a company moves its own staff into an investment property, the fair value on the date of transfer becomes its deemed cost for future IAS 16 accounting and depreciation. Case 3. IAS 2 inventory to IAS 40 investment property. When an inventory property built for sale is leased out under an operating lease, any difference between its fair value on transfer date and its previous carrying amount is recognized in profit or loss P&L. Before we wrap up, let's highlight 4 classic traps examiners love to set in ACCA 1. IAS 23 interest income deduction. Always remember to subtract interest earned on temporary loan deposits from borrowing costs before capitalizing specific borrowings. 2. IAS 40 fair value. Gains, location. Do not put IAS 40 fair value gains into OCI. They go straight to P&L. 3. No depreciation under IAS 40, fair value. If a question says a property is held under the IAS 40 fair value model, do not calculate or deduct annual depreciation. 4. Group versus individual statements. Always check whether the question asks for individual financial statements or consolidated group statements when intercompany leases are present. That brings us to the end of Chapter 6. To solidify your knowledge, make sure to work through Section A and B practice questions on IAS 23 and IAS 40 in your revision kit. In our next module, we will tackle Chapter 7, Impairment of Assets, IAS 36. Thank you for watching and keep up the great study momentum.